Hello and welcome. My name is Benoit Poliquet. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the third quarter 2023 charts and stocks version of the video where we go in depth in terms of the stocks we own and some of the interesting research we found this past quarter. I've been showing this slide over the past few quarters, but it's basically our prevailing winds in terms of the opportunities that we see in the markets. One is demographic, technology, profitable technology names, pharmaceuticals, and medical devices. Energy remains a focus for us in terms of production, but also energy services and infrastructure or transportation. We're still loving industries that have a high burden of regulations. To us, it's a moat or a barrier to entry. So utilities, financials, and we feel that inflation, that burden has not been broken, if you will, and we're looking for companies that can weather higher periods of inflation and can capture technological disruptions, whether it's through brands and pricing power, they're providers of critical solutions, or they act as a toll keeper. Let's cover interest rates, which are really fundamental and were top of mind for investors this past quarter. Investors were concerned about interest rates. What we see here is since 1960, a graph depicting the 10-year bond rates for Canada in blue and in red for the United States. And you could clearly see two cycles, maybe a third one coming on. So the first cycle will be rising interest rates, peaking in 1982. And from there, we saw a significant decline in interest rates all the way down to the first quarter of 2020. And since 2020, we saw really a historical and dramatic rise in interest rates. Now, when we're looking at this perspective since the early 60s, we can see that the current interest rates, while significantly higher than they were 2 or 3 years ago, are really not that dramatic in terms of levels, if you will. So another way to think about it is interest. So there was money to be made in the stock market even when interest rates were higher than they are today. It's just that investors need to realize where is the cycle going and what kind of interest rates are we going to be working with. So here's what I mean. I showed you the long-term cycles of interest rates. So basically, since the 1960s, peaking in 1982, the average annual return for the S&P TSX, the Canadian market, was 7.67%. So even though interest rates were rising, equity markets still managed to make some money. Then now there obviously was some periods of volatility, but if you had, a longer-term horizon, you still made a significant amount of money. And while interest rates started to decline in 1982, the markets, the annual return or expected return is actually smaller on an annual basis than it was when rates were rising. Now, there's many other factors that would have influenced that, but my point here is that you can make money in rising interest rate environment. It doesn't follow that because rates are rising, equity investors will not be able to make money. And here's another example when rates have really bottomed in 2020. We still had a significant rise in the TSX, moving from basically up 13% in a little over 2 years. When we look at the S&P 500, the American markets, we can see that the periods leading up to 1982 were actually the reverse. The returns were lower when rates were rising than when rates were falling. So the return, it's really the flip side of the U.S. in terms of experience for investors. You went from 4.6% on average to 7.42%. Again, notice the volatility. Now, this is a logarithmic chart, which really shows you the impact or change in values. Now, there's been a lot of talk about demographics and specifically housing, so I wanted to look at that for a minute. So the concept of immigration has really been politicized this year and probably in previous years, but I've just seemed to have noticed this year. So I wanted to look at the number of new immigrants in Canada since 2000. That's the latest or the furthest back I could find in terms of charts from statistics. Can't say that word anyway. You'll forgive me. So clearly, there's basically been a doubling of new immigrants in 2022. And obviously, we had the COVID plunge here, but basically in Canada, we've had on average about 250,000 new entrants each and every year in the past. And when we look at monthly housing starts, the idea is, it's not a direct fit, but the idea would be that new housing starts would more or less follow how many new Canadians or household formation or some semblance of that. So if we were letting in, say, 500, 250,000 new entrants a year, not everyone is going to buy one home, obviously. But the idea is to have sort of a trend that more or less fits in terms of household formation. And household formation is obviously made up of new families being created, if you will, but also of new entrants coming in. But right now, you can see that this is the latest data from CMHC. In Canada, you're looking at about 245,000 new homes in August on a year-on-year basis being created. And so obviously you can see that it's largely a lot less, if you will, than the 500,000 or so that we let in terms of new immigrants. So obviously that has an impact on pricing, on availability. So the housing pricing, houses on one hand should be lower in the face of higher interest rates, but then you have this supply-demand imbalance based on policy decisions. And let's see if it's the same in the US. Here's a great study from Harvard looking at trends in housing. So the average household growth, let's call it household formation, basically in 2-year increments. The idea was the expectation in the US was really around, again, 1.5 million, give or take 1.3 million in terms of projection of new households being formed every year. And since COVID, just before COVID, the household formation have exceeded forecast. And why is that important? Well, a lot of these forecasts is how the industry will base itself in terms of new permits, because think about it, it takes about 10 years from flash to bang from when a land gets purchased, serviced, permitted, and then it's ready to be housed. So it's a 10-year lag. And so the industry looks at these projections in terms of figuring out how much supply it needs to create. Now, when you you need to think back from 2005 to 2007, say there was an overabundance or oversupply of housing. So since then, the industry has really been very tight in terms of its ability to project. So the growth in household is obviously, it would make sense. It follows that it tracks between the 25 and 35-year-old age group. And from a demographic perspective, we can see that the millennials are heading into household formation years. It's not going to let up. So that's the challenge really ahead for the industry and policymakers, is that there's a demographic cohort, if you will, that is moving into the age of household formation and home purchasing. The latest release from the Census Bureau in the US has us basically having housing starts and permits running about 1.5 million and completions right about 1.5 million. Now remember, there was a household formation that was significantly above that. So really you were creating this sort of housing shortfall in the US that is going to be a challenge. Let's move on to the next section, which is the market history portion, where we're going to look at different markets in terms of their performance, but with a longer term perspective. So we'll start with the US here, or the Canadian market, I should say. So really what I want to draw your attention, so this is the S&P TSX, and it's sort of been trading in a box basically between 18,000 and 21,000 since early 2021. And so if your Canadian portfolio hasn't really moved much, it explains by that market or by that reality. So there's a bit of a seesaw action. So we saw a downdraft during COVID, a big bounce back, but since then we're kind of, the markets are more or less within 10% or so of the pre-COVID peak. If we move to the U.S. market by the S&P 500, if we look at it, it's similar shape, but we are much higher than the pre-COVID peak. And so we're about 20% higher than that. But we still have this sort of box shape in terms of trading and sort of the markets behaving or staying very tight in this box. And the reason equity markets in the US have done better than Canada's, one of the largest contributor would be technology. So here's the NASDAQ composite. It really is significantly higher, say 50% higher than the COVID peak. Now, obviously, it had a pretty big downdraft in 2022. And we're nowhere near we're about halfway from the peak, from the bottom, if you will, that we had at the end of 2022. And so the question remains, in terms of higher interest rates, typically faster growing companies where they have their future profits further out into the future have a larger or are much more impacted by higher interest rates than companies that are growing less or even are paying a dividend. So that's called a duration. So right now, investors are oscillating between higher interest rates and the impact on future profits, but the fact that some of these technology companies are still growing in the face of an economy that seems to be slowing. One of the charts that I like to look from time to time is the rotational chart. So this is the TSX, and what I'm trying to find out here is what are the sectors that are actually working within the index. And you can see here that basically outside of energy, nothing's working. You're seeing utilities fall 13% so far in the past 12 weeks, consumer discretionary. So basically everything's being hit or adjusted in terms of higher interest rates. So we see the TSX in the past 12 weeks being down 5%, and everything else is kind of negative, save for energy. If we move to the US market, it's got obviously more sectors, but basically it's a lot of the same thing. For the same 12 weeks, we see that utility sectors are the laggards, as are consumer staples, which are basically risk-off stocks. So it's interesting, even though markets are down, the sectors that tend to do well in a down market or even a recession are actually leading on the downside. What's working in the U.S. obviously is energy and communication services and technology, which are less bad, if you will, slightly positive on communication services, and technology is doing slightly better. The S&P 500 as a whole for the past 12 weeks. So this chart sort of tells you what's working and what's not, and currently not a whole lot is working. Now, this leads us to our individual stock commentary. Now, I'm not going to cover every single stock that we have in the portfolio. But I'm going to comment about the stocks that I'm responsible for, the portfolios that I'm responsible for, and talk about maybe some of the best performers and some of the weaker performers. So here's a great example. ATCO, which is a Western Canada-based conglomerate, but largely its performance is dependent on one of its subsidiary, which is a utility company. The yield is north of 5%, and really the stock has peaked at 45 and is down substantially since its peak last spring. Bank stocks have also not fared well, so the old adage that you can't lose money in bank stocks is just not true, and here's an example. Scotiabank peaked in early 2022, and since then is down substantially, call it 25%. The yield is up to 7%, and at the close of the last quarter, and it's effectively the stock is right back to levels not seen since late 2020, early 2021. So there's a lot of, it seems to me anyway, it's my opinion, that there's a lot of bad news. We know that housing, consumer spending, there's a lot of challenges around banking and lending, but there seems to be a lot of bad news baked into the current quotation of something like Scotiabank. Luckily, not everything in the portfolio is negative. So one of our stalwarts position is Alimentation Couche-Tard, which is a company that basically we call that a top right stock. So it's performed very well so far this year. And we'd be looking to add to this stock on weakness. So what weakness does that look like for us? For either clients that don't own it yet or clients where we would like to add more of it, we'd be looking at the low 60, mid 60s. Ideally is a place we'd like to add it. Dollarama is another sort of star performer for us. Again, a stock that obviously heading into a recession, low-priced goods merchandisers should be something that where you want to be. But I'll show you that not every merchandiser is doing well. But again, we'd want to be adding to this position, but certainly not chasing it up here. Energy names have done well, so one of our picks is Synovus, but it's still trading in a box. I mean, it peaked way back in 2022, and it basically has been in this range of 20 to 28, which granted is a big range, but still a range nonetheless. So basically, and investors are digesting, on one hand, the lack of investment in new resources, but on the other, in an economic slowdown, typically demand for oil products does come down. You might notice a theme here. We have another utility that we added to, Emera, which is the old utility from out east, or down east, I should say, but also it owns a large utility in Western Florida. And so, interestingly enough, yield nearly 6%. The stock also peaking in April of 2023, and you have to go back to mid 2022 for the latest peak. So the stocks are down substantially, but we felt very good about adding to a position here. Enbridge is another company that we continue to add to for either new accounts or where there is room. Yield is nearly 8%. The market, Enbridge did an acquisition down in the US, and the market really penalized it for it. We actually feel very good about this acquisition. It's a great way to enter new markets. It's more of a retail distribution purchase, and Enbridge is actually quite a dominant player when it comes to natural gas distribution at the retail level. We know them as well as retail distributors. You get a bill from Enbridge, but also at the wholesale level. So they're really integrating their operations. The yield is difficult and sustainable. It's difficult to surpass or not look at, and it continues to be sustainable in terms of cash flow and earnings perspective. Now, we do own technology names that just happen to be, we like European names better simply because they're significantly cheaper than their US counterparts, even though they operate in the same industry. So Dassault Systèmes is a manufacturer or a provider of software as a service or subscriptions, if you will, in the manufacturing, but also in the life sciences business. So the stock, again, there's an embedded euro US dollar conversion here, but the euro being very cheap in regards to the US dollar, we feel this company that is growing quite nicely offers great value. Dollar General is a company that we continue to love in terms of current values. Kind of disappointed that we bought it at higher levels, but we'll continue to add to it. Dollar General is the U.S. One of the largest retailers in the U.S. in terms of number of stores, and also in terms of growth of those stores over time, meaning in terms of additional new stores being added every year. They was just announced at the time of recording of a new CEO, which propelled the stock up 8% as of the date of this recording. And we feel that this company going forward will do very well in a tough environment economically, which unfortunately does help its business model. Disney is another name that we own and continue to add to. It remains to be the dominant player in terms of media properties, in terms of characters, in terms of production houses and distribution. Now, it's got a lot of hairs on it, as we say, a lot of problems operationally, and but they continue to move forward and solve them one by one. And so we feel that from the current valuation, there's a lot of negative, bad news baked into this stock. Continue to add to it. Probably will be in the quote-unquote penalty box for some months to come, but expect some great things from the company when you're looking out 1, 2, and 3 years out. Intel is a name that we owned for a while and been adding to the position. It is bounced back from the lows of 24.25 that we saw last October, and it's up substantially, up 50%, and not garnering a lot of attention for that move up. One of the best performing stocks in the U.S. in the same time frame. And we feel that the turnaround is well entrenched with this company, and the stock price should follow. Logitech is the first of, or the second of European names that we own. Again, sort of a turnaround story after a significant fall from the peak that it saw in the second quarter of 2021. Again, the company has no debt, is very profitable, but really was overbaked or overcooked in terms of its future profits in relations to its current quotation, and basically fell back to earth. We continue to add to the position for new clients. L'Oreal is another company that we've held for a very long time, and again on weakness, it seems to be coming off here a little bit from its recent peak. We will be adding to it. We will not be surprised if the stock did breach from the top the $80 mark, and we'd be net buyers in the low to mid 70s. Louis Vuitton is a name that we've owned for a long time as well, and would like to add more to it. It's one of those core positions. So LVMH, again, would be a buyer here in the 120 to 130 range. It might get there. Remember, there's an embedded euro price, and the US dollar has been on fire versus the euro. And so the company is doing very well in terms of executing its retail strategy and its growth strategy. 3M is probably one of our worst performers, and we continue to be on a watch for it. On the upside, it's got a sustainable and very high dividend. On the downside, the company seems to have a lot of trouble, especially with a slowing economy, to generate some growth. And so it's a story that remains to be seen. At its current level, certainly represents a significant value. But it'll be interesting to see, and we remain, I don't want to say unconvinced, but watchful in terms of whether or not the company can execute the turnaround. So Medtronic is a company that we continue to like a lot. However, it's caught in an interesting short-term, we feel anyway, a short-term trading situation where there are two stocks, which I'll show you in a minute, that are doing very well in terms of weight loss treatment. Novo and Eli Lilly. Now, within that concept, what many market participants are doing is they're buying those two stocks, which have this quote-unquote wonder drug in terms of weight loss and diabetic treatment. And what they're doing is they're selling off everything else that is remotely related to obesity. So whether directly or indirectly, whether it's on the medical treatment side, on the diabetic side, or even on the nutrition side in terms of food. So here's the chart of Novo Nordisk, the makers of Ozempic. The stock is basically on fire from 2018 or 2019, $25. COVID low of $22.50, so let's call it $30, and basically it's tripled since then on the back of the clinical trials and the commercial success of its diabetic drug, which also is now being remarketed under a weight loss protocol. And so what's going on is these stocks, Novo Nordisk and the other being Lilly, which I'll show you in a minute. Here's the chart for Lilly, which, pre-2020 was kind of a very good stock, very good company, but basically and now the stock has gone absolutely parabolic. So the theory there is that we all know that there's an obesity problem in the US, and so what investors and some analysts are doing is they're projecting out forward a market share of, say, 15% on 40% of the population, and extrapolating what the profitability of that drug should those companies get to a 15% market share. Now, inference trading tends to not work, meaning an inference trade is if A happens, then B should happen, therefore you should buy C. This gives you exposure to B. And so here's what I mean by that. So recently, stocks like Coca-Cola have really seen a significant drop. So the stock basically, and look, Coca-Cola is a slow grower. We'll certainly admit to that. But basically, the stock is down 12 from its peak in a very short while. And this is a stock that typically does not have a lot of volatility to it. Here's another example. Here's Yum Brands. Again, significantly is a significant downdraft in the past few months. And another stock, which is RedMed, which are the dominant players in the CPAP business, that stock basically was cut in half in a little over basically 2 months. Again, it's all part of the same trade, going long the weight loss drug makers and shorting or selling anything that is making products or delivering services to overweight or obese people. So it's an interesting dislocation here that which we will take advantage of over time. You're getting the picture here, but here's the last example of basically a stock that has been down 30% in a little over 2 months or 3 months in something in General Mills. So again, the contrarian in us can see that there's no doubt that these weight loss drugs will have a significant positive impact. It's unknown what the long-term impact of these drugs are on the population, but what clearly is evident to us is that these stocks, in terms of companies that are expected to see their sales fall, I struggle to understand why the number of Cheerios will go down by 30% thanks to the advent of Ozempic and competing products. So the current situation with higher interest rates is also, and the sort of love affair with these weight loss drugs has given us a lot of values where we're seeing a lot of bargains, for lack of better words, that we will take advantage of over the coming months, where we can lock in dividend yields of 3, 4, and 5% at what we feel are fairly low valuations. It's not necessarily a call that we think that there will or won't be a recession and how deep it will be. We just can see the dislocation, and we can also see the value in a lot of these companies. I will end the presentation here. Thank you so much for watching. If you have any questions or comments, as always, you can send us an email and let us know what you think. Thank you for watching.